now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today we have my guy Benjamin from the ROI channel. How you doing today?
I'm doing very well, my friend. Thanks for having me on once again.
Looking forward to the Rule Symposium, seeing each other in person.
Absolutely, I can't wait. It's a doozy for me to get there. I've got to go through basically every time zone there is. I've done it before though, so I'm super excited, man. We're going to have a lot of fun, hopefully learn a lot, and make a bit of money off the back of it.
Yeah, yeah. So you said you're gonna do some running, so we gotta get out there and run in the heat, the humidity.
I don't know if I'll be running. I like the Stairmaster. I'm getting a bit old, mate. My knees hurt, so Stairmaster's good. A bit of
Yes.
cardio, get some blood flowing through the brain, recover, sweat out some margaritas from the night before, perhaps.
Yeah,
We
yeah,
do
for
what we got
sure,
to
for
do.
sure. Maybe we gotta try to tap in with somebody to get some of these shareholder dinners, man. We can go to. I may have to show you some of the ropes, but yeah. So Stairmaster, that's one of my favorites, man. So yeah, we got to see who can outlast who on the Stairmaster.
Okay.
I'm upwards of 35 minutes, but I'm sure I can go longer. But maybe we can have the audience place their wagers on who can do the longest on the Stairmaster. So a lot of things been happening in the markets lately. There's a lot of talk about, I mean, the tariffs is one aspect of it, but the what's happening in the bond markets, what's happening with U.S. assets, and there's a lot of talk about foreigners moving away from U.S. assets, and we know that U.S. assets has been like overvalued, at least the the top tech companies and everything, like the S&P 500 companies, those have been overvalued for a long time. We haven't seen a huge move in emerging markets in a while, and I'm wondering if this is like a signal or what. But what's your take on what's going on?
Yeah, I think there's been a hell of a lot of noise. As you know, I've been positioning for this type of a move for a little while. I see that people take their cues from the DXY, and the DXY really is mainly just a cross rate between the US dollar and the euro slash Great British pound. So, as far as emerging markets goes, it's not particularly indicative. However, you have seen the likes of some of the South American companies really pick up. Part of that will be due to the move in the DXY. Part of that will be due to simply the fact that it was so darn cheap with elections coming up next year in both Colombia and Brazil. So that there are quite a few geopolitical forces happening. I start to see the world as, or position myself for a world that's in these kind of little groups. So America would be led by the US. We saw Secretary of the Treasury Scott Bessent go to the Casa Rosada in Argentina for the first time in a very long time that's happened. I would imagine there'll be some kind of announcement between the US and Argentina around either tariffs or swap lines to encourage Argentina and all of its produce away from dealing with China and more towards the United States. And we saw all sorts of things happening. And honestly, to me, I view the US as its own economy. And one thing that our friend Steve from the Value Degen, his thesis around the baby boomers having $75 trillion of wealth accumulated on their balance sheet is an economy in and of itself. So for me, I haven't really been too concerned or affected as much with regards to the tariff talks because everywhere that I'm invested is kind of in its own isolated pocket. I don't invest in importers or exporters. And so I'm targeting that $75 trillion worth of wealth and that American economy, be it North America, South America, I view that as the market after which I'm going. I don't operate in China. I don't operate in Russia or Europe. So for me, tariff talk maybe gives me some negative sentiment across the price action, which I view as an opportunity to buy. Apart from that, I'm not particularly interested.
Yeah, 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 for sure. I mean, yeah, we definitely saw like a decline in the prices within many of the equities and such, and there's been a lot of volatility. Um, and I think that it's kind of like obviously when you do your studying, your research, like you're searching for the value of the company rather than the price. However, the price does like shake a lot of people out, right? Even if like the companies are valuable, right? And so I'm kind of wondering about even in recent history, recent weeks, the oil sector took a big dive. We had a big sell-off like a couple of months ago. I think it was a month or two ago. I mean, Valaris hit like $29, and some of these other companies went significantly lower. Then we had like a bounce, and then they went back down to like those prices again. And so obviously that doesn't communicate anything about the value. But is that signaling anything for you? Like some people say that when oil price drops, like that means like we're in recession territory. Then if we are in recession, what does that mean for oil?
It certainly can indicate a recession. Let's walk it through bit by bit. When you're talking about oil, there are various different markets. So you've got the oil capex, and there are two main ways that I'm long oil capex. One has been through the offshore sector, where my margin of safety was more around the discount to the replacement value of these assets. And then I've got the land and royalty holdings that I've been talking a lot about over the past year. So, with regards to what we've seen, when you have things changing, it almost changed by the hour. If you were on Twitter, I had one of the most entertaining days of all time. I think it was the Tuesday here, where we had tariffs, then we weren't, and then we were changing back and forth. It was like a tennis match. And what you've got to understand around the offshore sector, these are based on longer term decisions. So final investment decisions will be based over at least a year in terms of leasing out charter rates to the likes of Valaris. And the projects for the operators who are going to engage Valaris in those types of projects will be looking at multi-year price environments to construct these types of activities. So the uncertainty has meant that no one was really anticipating there'll be a strong investment environment at least this year until we get some kind of an understanding as to around the tariffs, whether that will affect oil and gas. No one really knows, even still, I would argue. So on the offshore space, that's what I think has been a big part of the sell-off. Then you've simply got the sentiment around the recession. Most likely, we will end up in some kind of recession. I find it hard to anticipate that we wouldn't. And I think if you look politically, the game theory would be if you want to do these things, such as renegotiate and make some changes to trade deficits between countries, which is what the Trump administration wants to do, then you're better off to do all these things, which will be a shock to markets and likely recessionary in the short term. Politically, game speaking, you want to get that out of the way first. And so get that over and done with, have a nasty first 6 months, 12 months into your term so that things can recover just in time for the next election cycle. So there might be, I think there's probably intelligent game theory around if you are going to do this sort of thing, then doing it early and getting it out of the way would be a good idea. At the end of the day, you might ask yourself, trying to reshore the manufacturing, trying to increase, in this case, we're talking about US productivity in manufacturing. Maybe you ask yourself whether US workers can work for the same kinds of wages that Chinese workers were. I think the answer there is pretty straightforward.
Oh.
And therefore, and therefore, these tariff policies, should they go ahead, will just add further inflation fuel to the fire.
hmm Yeah, yeah, for sure. I mean, and there's a lot of like a lot of issues. I mean, because like when you look at like oil, refineries and such, it seems like, the US has a lot of that type of infrastructure. But when you get to like the rare earths and many of these other commodities, I mean, even uranium, I think there's one enriched uranium enrichment company that's kind of based in the US or whatnot, Centrus. And so it seems like it takes, decades to like, or however long it takes to get through the regulatory process and to even get to these um these situations where you're able to refine those. I think uranium fuels is like probably one of the only other ones that has like these refinery and
Mhm.
capabilities to process rare earths and such. And so, what's your view there? Like, 'cause it seems like that's a is that possible? I mean, it's possible, but it's kind of I don't know. I feel like it's kind of reaching pie in the sky at this point.
Well, it's going to take time. If anyone's read the works of Jim Rickards, who I really hope to meet at the symposium, by the way, a lot of his work, and he wrote a whole book about supply chains called Sold Out. It's a monumental task to try and change supply chains. So on the back of COVID, the argument would be, oh, we just paused during the lockdowns and now we can just pick things up again magically, which of course is not what happened. And we saw some crazy things happen in the shipping markets. For strategically critical minerals and metals such as rare earths and uranium, I think you're going to see, if we continue down the path that we are, we're going to see security over cost. It's going to be a case of we need, if we're talking from an American point of view, let's say in the West, we need certain amount of these critical minerals, and it does not matter what they cost. We have to have them, and I think that both the rare earths and uranium would fall into that category. It won't happen overnight, but I think that over the next 5, 10, 15, 20 years, what we've seen at the turn of this new year has really been a total change in the way things were. The world order is not going to be the same, and it looks more and more like we're having these spheres of influence and pockets around the world, which will need to be somewhat self-sustained, as opposed to the idea of where we were when we turned 2000, 2001, with this Chinese manufacturing miracle allowing for globalization, which was really the US exporting inflation around the world by cheaper Chinese manufacturing.
Hmm. Yeah. So with the I'm thinking about the whole thing with fiscal responsibility and such, and that's been like a big theme. I mean, it's more of a macro theme, reduce the deficit, reduce funding or eliminate fraud, waste, and abuse, and blah blah blah. And it's like, okay, like that's a good goal to have. But at the same time, it's like we're raising the debt ceiling. We're, you know, and so I'm like, okay, is this like smoke and mirrors, or are we, are we? I just don't see the amount of pain um, coming from you know eliminating some of these entitlements and such. And so I'm just kind of wondering your thoughts on that. I mean, obviously you're Aussie, but you invest in America and such, and to take away the punch bowl, right? I think that means like people are going to have to experience pain, and then ultimately, when Rick Rule, he's bringing David Stockman to the symposium. I'm looking forward to speaking with him. But just being the former head of the Office of Management and Budget, and he just breaks down the numbers, and the numbers just don't make any sense. Like the numbers are like, yeah, that's for us to do this, we're gonna have to experience a lot of pain and such. And so, I mean, just getting the United States to like becoming like a more wealthy nation, I'm just kind of wondering, um, how's that going to happen?
Yeah, it's a very good question. If you look at the arithmetic in question, I think I agree. I think it's wonderful that you get rid of as much fraud, waste, abuse, or just simply unnecessary government spending. Obviously, I'm all for it. I wish I wish that would happen down here. But when you look particularly at the US fiscal situation, the balance sheet, so much of that are these untouchable items in inverted commas. And you're right, I don't see in a democracy, I really don't see any way that they would need to that they would be able to cut those entitlements out. They're rusted on, and so therefore, really, the all roads lead to inflating away the net present value of those obligations. And the recent news around reshoring and manufacturing and adjusting trade deficits between the US and other trading nations, it's only going to add inflationary fuel to the fire. If you take a cursory glance at the balance sheet, I won't do it now because people will be bored with the numbers, but to get to the point, as far as I can tell, the US really needs to run 1 to maybe 3 years of inflation above double digits. That is like above the increase in the productivity in order to reduce that debt burden. And so that remains my main investing thesis around how to survive that and hopefully prosper. And I think that if you look towards the real money markets, the crypto markets and the gold market in particularly, over the last 12 to 18 months, I think that that's certainly been an indication as to what the central banks believe will be the policy response.
Hmm. So there's been like some recent news with Powell and Trump, and they've been they've been kind of hinting at this disagreement, and so Trump wants to lower interest rates. Obviously, that's Powell views that as being inflationary. The money printers are going to have to come on, like inflating away the debt and such. The Fed isn't necessarily being too dovish right now because of this issue of inflation. And so it sounds like, what needs to happen is inflation needs to run hot, but then we have, a Fed that wants to keep inflation low to, I guess, protect the average citizens. And so, what do you see happening there?
Well, and this will, I'll give you your headline, Daryl, and this will tie into a previous question that you asked me. Really, people, in terms of the game of inflation, the central banks and the Federal Reserve are the most overrated players on the field. People think that it was really the Federal Reserve that was responsible for curbing inflation in 1982, eventually, when Volcker raised interest rates a certain amount over the rate of inflation and got to like 20s, I believe, or high teens. Yet you can't really understand inflation today without understanding the disinflation that took place before it. So I would argue, and I'm not alone, that in the 80s, around that time, ask yourself, did the Federal Reserve create more oil? Did the Federal Reserve create more goods and services in order to help with the supply constraint part of the equation? And of course, the answer is no. The Federal Reserve can change the short term notes, the short term cash rates. They can't even target the bond market like they say that they can. Without going into details, really, I think the disinflation that we've seen was due to a few very, very odd occurrences. The first was the breakup of the Soviet Union. So, say whatever you want about the Soviet Union, they had all sorts of goods, commodities to bring onto the market. And after the 70s, the supply constraint, inflation, where we had the oil embargo and all that type of deal, the Soviet Union was able to bring some of that supply relief onto the market. So no one ever talks about that. They all give Volcker the credit. And sure, he raised rates above the rate of inflation, and that helps on the demand side, but it doesn't do anything for the supply side. Let's consider again that the balance sheet was completely different. US debt to GDP, if I remember correctly off the top of my head, was in the 30% range. And now we're at like 120, 130. So we're not going to be able to have the same policy response, I don't think. And then if we think about another really rare event um, that took away a lot of the inflationary pressures was through the disinflation of labor costs by the US or the Western world outsourcing all their labor and manufacturing to China. If we look at those two things now, they won't happen again. And so, with regards to what happens with the Federal Reserve setting near-term rates, I think it's a I think it's a sideshow. I don't think that they can impact well, we know we can't impact the supply side, as I just mentioned. Impacting the demand side, I don't think that they have the ability without severely causing a circus in the bond market.
Yeah, yeah,
So there you
yeah, for
have it.
sure.
We have
Definitely.
all this noise about interest rates and short-term rates and all this sort of thing. It may affect currency cross rates in the short term. In the long term, the hands are pretty much tied, and it doesn't matter who's in the Federal Reserve seat. Really, that unless they can get out there and start drilling for more oil or lower manufacturing costs inside the US, um, there's nothing that they can do from a supplied side perspective.
Yeah, yeah. Okay. Yeah, that makes total sense. So, investing implications in an inflationary environment. We have gold sitting at 33.50, 33.40, somewhere around there. Um, what's been your view on gold? Some people saying that it's overbought, some people saying it's going higher. Want to get your outlook.
Yeah, I mean, depending on the time frame, right? So short term, you look at the RSI and we're in way overbought territory just because I think you've seen the retail investor, particularly in the East, start to return to the gold market. So over the last 12 months, we had central banks buying and buying and buying. People have now seen some of the price movements, and so retail's jumping in on the bullion trade. I'm super excited about the ability to work with Battle Bank. So Uncle Rick getting Battle Bank finally into gear will be amazing because I don't want to sell my gold and not for probably another 10 years. So having that ability to just hold my gold, my physical gold in there, and then to take loans out or to lend my gold out potentially is an amazing opportunity. So I have a fundamental basis of gold bullion that I've been accumulating for several years. I'm not buying any more right now, just because I see some other opportunities. I've gone a kind of a barbell approach with the gold. I have my gold bullion and I have my gold royalties, which still, if you compare the ratio between the gold metal move and the royalties are still undervalued. So
Mhm.
I'm the royalty king for a reason, mate, and see no reason to change that right now.
Yeah. So, let's I'm gonna give you a screen sharing ability just in case you want to share screen on anything. Um, so with the royalty and the streamers, I recently talked to Uncle Rick about this because we saw recently, if you look at the yearly chart, I mean, you see Franco Nevada up 40% or 30 to 40%. Wheat and precious metals up about, I think it was about 50%, and then Sandstorm up about 40 to 50%. But then Gold Royalty, which is one that I buy, and you've done a video on as well. And
Mhm.
so what's your take there? Like, I mean, obviously the bigger caps they tend to move first. Um, and so I was kind of wondering. I mean, it has moved some, but I guess when they first IPO'd, it was maybe just the price was just too high compared to the value or whatnot. But it sold off for a while, and then now it's starting to move up. But just wanted to get your view there.
Sure. So I'll take the first part first. Obviously, you look at the bellwethers with Franco and with Wheaton, and if you're comparing them to where how many shares of Franco would buy an ounce of gold, for instance, um, gold still looks Franco still looks very cheap compared to gold. So I would say at the moment, if you believe in a higher gold price, then why don't you just buy the best in class? So there's one aspect to it. Then another thing, again, something that I'm writing a lot about, so I'm trying to get this point across. People just look at overviews of certain metrics. So they'll look at Franco and they'll look at the PE and they'll decide it's too expensive, but that doesn't that really doesn't showcase everything that the company has, because nearly 75% of their royalty contracts aren't even in production yet, and they won't be until gold hits a higher price. So that's kind of like the equivalent of you looking at Franco if it was an apartment building and saying Franco's expensive, but they're only renting out the first floor of their apartments. They've got all this extra value. People can't see it yet because they haven't come online. So that would be one comment. With regards to the gold royalties, I have a whole basket of small royalties, and some of them are super obscure. Gold royalty, I just think, is in that range where it's a small cap and it's going to take a little while to hit this traction with their revenues. They've only been public for what, 3 years or so, and 3 or 4 years, and yet already they've had triple-digit growth in their revenue. So really, from a standing start, it's amazing what they've done. I think gold royalty, if you give it 10 to 20 years, honestly, I think it'll be one of the better investments I've ever made. That's what I'm hoping for, at least. It's trading at a massive discount to its book value, but I think you'll see it trade at quite a discount until it hits a certain scale. and that will be the trigger for a multiple re-rate. For now, I would just look at what their revenue is doing year on year and what it will take for them to inflect to being free cash or net income positive, which if it's not going to be this year, I think it would definitely be next year for sure, based on the numbers that they're putting out.
Mhm. What's the price to book ratio that you have for gold royalty?
I am going to tell you in just 1 second, sir, as
Yeah.
I look it up. It is currently at a quick glance, I've got it at half book. So 50% of book value. It's recently run up. So from my cost basis, it's up nearly 30% overall. It just got to a point where it was trading at roughly a third of book, which was just ridiculous in terms of the assets on the balance sheet. Looking through the revenue growth, we should hit 16, 17 million this year in top line revenue from zero, and then it'll be almost a double every year for 2 to 3 years based on what the analysts are projecting. And obviously, if we get a higher gold price or higher volumes, then that's all call option gravy on top.
Hmm. And then we've talked a little bit about, or I've seen you talk with Uncle Rick about Sandstorm, and so I was in Sandstorm for a while. I still have them, but what's your view on Sandstorm Gold? I know they were trying to pay off their debt, and they were making a lot of cash. Um, and the last time I interviewed them when I was talking with Nolan Watson.
Sure. Sandstorm's kind of in that next range. So when you've got the really small caps like your gold royalties, Sandstorm's more than 2 billion now. So they're not really a small cap. They're in that kind of next range. And I like what they've done, but if you look at what you're paying for that mid range, you might be paying a 20x the free cash flow yield. To me, what I actually did was sell some of those Sandstorms and Cisco's and start to go either side. So I bought some more Franco and Wheaton, and I bought more of the gold royalties, the empresses of the world. So I currently don't have a lot of exposure to those kind of next range up, if you would. So 2 billion and up. I don't have much exposure there. I've got much more confidence going either side of that.
Got it, got it. And then silver. So silver, physical silver, we had a sharp decline from about 34 to between 34 and $35 an ounce. Went down to 29 briefly. I was able to pick up some more physical at that point, and then now it's kind of rebounded a little bit, probably about 50% from the drop. But yeah, what's your view on silver right now? I mean, it's kind of late to the party, or per se, or
View remains the same. I haven't bought any more physical silver. I just hold that which I've had for a while, and which is not an awful lot. I hold much more in the weight of gold. And in terms of the thesis is simple enough. It's not as easy to play it. You've got Wheaton. I guess you could say Pan American is fairly de-risked, but the price has already run quite a bit. I don't own any silver producers or any silver miners. Um, I think that the thesis will play out for silver, and I think that most people will not make any money from it.
yeah, yeah,
That's what I think.
yeah, for sure. Elaborate on it more. Actually, elaborate on it a little more. Most people will not make money from that.
Yeah, I'm gonna say that applies to quite a lot of themes. So I think the uranium thesis is easy to understand. There's a bull case to be made, and I think most people lose money. Silver the same, copper the same. Any of these extractive industries, I don't think most people, I think they just do silly things in terms of how they allocate, and they allocate to, let's remember, extractive industries, the producers and the explorers are the worst business model possibly in the history of business. They're capital intensive, they're cyclical, and over time, commodities are not an inflation beneficiary. The real cost of extraction goes down. And one thing that Doomberg and I discussed was talking about how producers and operating codes are basically big deflationary machines. They're trying to reduce the cost of commodities over time. And gold, you could argue, is robust, the physical gold, for its pure and unique monetary qualities. But all the rest, I think it's the same. People will buy most of the producers, developers, and juniors. If they get the timing right, they might make a little bit of money. But honestly, I think the asymmetry just favors the royalties. And gold is different. The physical commodity you can buy and you can do quite well. Silver probably as well, although it's less certain. And over time, you're looking for something that's capital light, but still has an interest in all of the bull markets for the commodities that I mentioned. And that's why the royalty model stands as completely different in terms that it's not cyclical like the rest of the commodities.
Yeah, for sure. So let's jump into platinum. So you and Steve both talk about Stillwater,
Mm-hmm.
and platinum, it's not really in the news like that. Like, I don't think anyone's talking about platinum besides you two, but I mean there may be a few people that so I want to get into like kind of that thesis, and then what makes Stillwater special.
Sure. So first thing I need to say is that I've made my money from Stillwater and I see better opportunities elsewhere. So apart from some super degen call options, which is pocket change, I don't have any more interest there. Backing up to answer your question, when you talk about platinum, you really want to talk about the platinum group metals. So you got platinum and your palladium and rhodium as well, which is a super interesting one. Again, it's a great thesis, extremely difficult to play, and most people will lose money on it. With regards to the depression in particularly the platinum and the palladium price, they have gotten to such depressed levels that they're below economic cost of extraction. Another reason why commodities suck over the longer term, with the exception of gold, land, and water. They're completely different. Platinum, right now, there are really only a certain amount of ways or a certain amount of places in the world that produce platinum. Russia, obviously, that's out of bounds for now. And you've got Southern Africa. So you've got South Africa, but you've also got Zimbabwe and probably Zambia that produce platinum in any meaningful degree. Sibanye-Stillwater is this big book of reserves. That's what it is. It has some producing mines. It did have a producing mine out of South Africa. That would be this, I believe, the Stillwater mine that got shut down because prices got so low. And so then you ask yourself, when it gets to that stage where prices get below the cost of extraction, it's not economic for producers to produce the commodity, so they start to shut in. That's usually the beginning of the inflection point before the rubber band snaps back the other way and prices demand far outseeds supply, which has been taken offline, and the prices start to shoot up, and then you get a whole heap of new production come online and you go back through the cycle. Similar to what you're seeing in oil at the moment, oil's dropped down. So what has happened in particularly the Permian Basin, rigs have been taken off the market, and that will eventually lead into a supply deficit, buoying higher prices over time. Sibanye, as I mentioned, is a book of reserves. That's what it is. It's got a ton of all sorts of good stuff, mainly platinum, palladium. It also has some gold. The bet with Sibanye is that it's trading at such a discount to the reserve value that over time that you can value it at roughly 20% of its reserves and still come out on top.
Yeah, okay, that totally makes sense to why there's some attraction there. So when we look at other types of assets, what other type of sectors are you looking at? I know we've talked about or I can't I keep saying we've talked about. I think I probably just read or seen one of your videos. I was looking at PAGS, PAGS.
Mhm.
That's more of a fintech type company out of Brazil and such. And so it seems like um, the ROI channel is about the ROI, not just commodities. And so I just kind of wanted to get so what are some of the other sectors you're looking at, and what's your take there?
Yeah, absolutely. So Pugs, I'll answer Pug Seguro first because it's pretty straightforward. is kind of like a square, you know, the little square payment system that you see in, I'm sure you guys have got it in the US. PAGS is mainly a fintech company providing payment solutions and also some banking solutions for Brazilians. Okay, so it's in Brazil. It's a super capital light inflation beneficiary. Why is that? Because it takes a clip of the volume. So it's not as good as Visa, but it's kind of like the Visa network system in terms of you've got this country of roughly 250 odd million people in Brazil. A lot of them are only recently coming into contact with the digitalized banking system, believe it or not. So they're just getting phones, they're getting the ability to pay for things with their phone, and they're getting digital bank accounts. So this is an enormous runway of growth. And once Pugs really acquires a customer, say you've got a news agency or a small business, and you use Pugs for your payment systems, your bank accounts, so on and so forth, all these transactions that go through, they get a clip of. And so in an inflationary environment where people are spending faster to dump, let's say, an undesirable currency, and in addition to that monetary velocity, you've got an increased unit volume. These guys can adjust, or their percentage revenue will increase without having to spend extra money for maintenance or operational capex. So payment and financials are kind of like this sector two of one of my themes of inflation beneficiaries. Another sector that I really like that no one seems to be talking about is the insurance sector. So our friend Steve has talked about his three main ways of playing this silver tsunami. And what I'm doing currently, and I'll have some pieces coming out for subscribers, is looking at insurance companies and financial companies in the US that have super high rates of return on invested capital and that are trading really for quite reasonable valuations. So one which I've only just started to buy is an insurance company, WR Berkeley Corporation. They have the ability to pass along cost increases to their customers. They're an extremely capital light business, and they have decades worth of track records that their return on invested capital is above 20%. So if you have the ability to, it's not quite the same thing, but so that people can kind of conceptualize this idea, if you had a bank account that was paying you 20% year on year, you can appreciate how putting your savings in there and continuing to save with that high rate of return over 20 years could lead to an enormous growth in your investment, right? So that's kind of the thesis behind this particular type of company. You're buying them at roughly 10 times their free cash flow, which is historically very, very cheap. You're buying them at roughly twice their revenues, which is extremely cheap for this quality business. This is a $26 billion company. It's not a small co. And so the ability to, at the track record and the shareholder returns policy of the company is super strong. Their ability to pass on their costs to customers during an inflationary environment is tried and true. Their demand is not going away anytime soon unless you think people aren't going to need insurance. And lastly, management is aligned with the founder and the CEO owning over 20% of the entire company. So these types of financial slash insurance companies do have that pricing power and ability to pass on their costs to consumers without having to spend any excess in terms of capex or opex to grow and maintain the business.
Got it. Okay. So you recently talked with Steve about Jackson Financial, and so is that a holding of yours as well? I've brought Steve on to talk
It
about
is.
Jackson as well.
It
What's
is.
what's kind of your take on Jackson? Steve has done like an amazing analysis of the company, and so I just want to get your perspective.
Sure. And Steve did a great job outlining the thesis, and I don't want to speak for him because he's done such a great job. Jackson is a very similar idea. I'm looking for businesses that can increase their revenue without having to commensurately increase their their capex or their opex. That's why commodity producers suck, because even though their revenues may increase, you'll find that their expenses for most part of the cycle rises at a faster rate. So royalties get a clip, but they don't have to increase their spending. Same deal with these types of insurers. Jackson is a little more niche in the sense that it's a life or annuities type product. So whereas property and casualty for WR Berkeley's and Chubb's of the world is obviously a little more broad, this is more niche and more tailored to people who will be looking for annuity streams, which will be the baby boomers. The thing I like about Jackson is it's just extraordinarily cheap right now. I think it's trading at roughly half its book, maybe a little over half its book. And that has been due not because they've made a mistake in the business operation or anything like that. From what I understand, that's purely been due to a major shareholder selling their shares after the IPO. The shares have left escrow so they can take their profits. And I think that, at less than 4 times earnings, price to earnings, I look at this company as a really viable long-term opportunity, given that it's a very simple business to run. They're annuities. There's going to be a demand, and they don't have to necessarily spend a lot to maintain their business or grow their business. So it fits that theme for me.
Yeah, yeah. And I mean, even the recent price decline, I had jumped in at around 87, and then it got down to about 60, 67, $68 at some point. I had to keep trying to, throw another invest another tranche and put more money in and stuff. And so trying to get my cost basis down. But it's definitely a solid company. That's one of the ones that I was like, okay, this is like this is a good long-term hold. And so yeah, so I definitely invest there. And then
Yeah, it's nice to have access to or exposure in your portfolio to some boring companies that will just keep doing what they do regardless of, say, a commodity cycle.
mhm,
And this, I think, gives you a nice source of non-correlated alpha. I do believe this company will outperform. The only thing I'm not complete, if there's one weak link in the thesis for me, it would be around what the company does with the derivatives that they take on to ensure that they can take their premiums and continue to pay out their annuities. I want to make sure that they haven't mismatched duration or yield, and it's hard to know that because they're not particularly straightforward or forthcoming with that information. So that might be a word
mhm.
of caution. It's the one thing, if I look at the company and I say that might be a weak link, it would be that.
Yeah, got it. And then lastly, the last company uh wanted to talk about was Digital Bridge. So this was I don't know if you did a public uh letter on this or if this was like
I
a
do, yeah. People
okay,
can
okay,
look at
cool.
this one. It's free. It's
I
not
like
public.
I hope I'm not bringing out any
Nah,
any
nah, nah.
exclusive subscriber stocks, but yeah, so Digital Bridge. You did an in-depth analysis on there on that company, and so what's kind of like what's some of the main things that attracted you there?
Yeah, it's Digital Bridge is a small holding for me. So it's not like it's a big holding, but it's an extremely interesting company. It's a private equity firm that takes into account the physical infrastructure that's needed for the rollout of this digitalization of the world. So data centers, AI, all that sort of thing. These guys invest in like the telecommunication towers and all that kind of stuff. So the theory is for me that Digital Bridge, now that it's transitioned from being a REIT, it was a REIT, they're purely private equity based company, smart guys that have a capital light business model now. So they can have a hard asset interest in all the physical infrastructure, but a capital light operating model. That's the thesis in a nutshell. If I had to compare it, I would compare it to the start of Brookfield Asset Management, which was based out of Canada. They were a very similar type deal. So if you're a funds management business, your expenses are really a little bit of office expenses and the salaries of the management. Where it gets interesting with Digital Bridge is this is all a wonderful theory until you look at the fees under management and how much that actually goes to the shareholders. So for the guys that are in management, this is like an amazing business. They make, I think, 350, 360 million just in fees last year alone. But just because you invest in the company doesn't mean that you're getting a clip of all of those 360 odd million. So if I can get a job there on the management, I think it'd be awesome. But as a shareholder, I think shareholders will probably do okay, but it's not one that's going to be a big position of mine necessarily. I think the ROI is going to go to the management with this type of beast.
Yeah, yeah. So what kind of scanners are you using? You're finding all these companies. I'm like, what? How's Benjamin finding these in these companies?
If you do what everyone else does and if you look where everyone else is looking, you're going to get the same results as them. So I don't use scanners. I know that's not very helpful to your question, but I have to be honest and ask. I'm reading through, I'm getting a thesis, and then I'm trying to look through different reports, different companies, turn over lots of different rocks basically to see if I can find something that would fit that thesis. So, for instance, when Steve started talking about the baby boomers and educating me around the economy, really, let's just imagine that as an economy of $75 trillion. I don't need to look anywhere else just now. I can go into there. Steve mentioned some of these companies, for instance, Jackson Financials, annuities, insurance type of deal. And I say, well, maybe there are other types of insurance companies. Why don't I look at their competitors? And you can start to go down the rabbit hole from there. And that's where I started to look at companies like WR Berkeley, and I'm looking at Fidelity and another company called Erie. I'll have pieces on all these sorts of things. Um, Other than that, honestly, it's difficult to say. I mean, you can look at landowners, which has been a big theme of mine. And all you do is you search landowners and you go through and you see which ones are public, which ones are private, which ones are the type of landowners that you want, which one fit your operating models. There's no way around that legroom. If you put things into a scanner, it won't necessarily tell you the operating model. And if you're looking at an operating model, you you need to figure out, okay, you've got a P of X, but the earnings aren't equal across different companies. So the earnings of Exxon are not equal to the earnings of, let's say, Texas Pacific. Why? Because all the earnings, in theory, they might belong to you, but if you're an Exxon shareholder, there's a certain amount that's just got to be reinvested in the business and to maintain, and then even more on top of that to grow. So your maintenance and your growth capex. And so when you look at TPL, it looks expensive if you run it through a scanner, but you don't appreciate that difference between the two. All the earnings, in theory at least, could be paid out to the shareholders in TPL due to the operating model of the business. So I'm not looking at scanners or valuation at all. I'm looking at business models and then valuing things once I understand the business model. I hope that makes
Mhm.
sense.
No, that makes sense. So you're doing so are you typically doing like a lot of the back of the envelope kind of valuations to see like if these are worth like going into, because I imagine like maybe you go into the rabbit hole of something you're like, man, that was a waste of time. Like
Oh,
or
yeah, it happens. Yeah, it happens. Honestly, Digital Bridge was a little bit like that. I came across it and I looked and I'm like, holy moly, this thing's got it's gone from 0 to 36 billion under management and they're making roughly 1% in fees alone. This is beautiful. And then you go further into it and you realize how much of that actually flows through to the shareholders. Once you take out the executive compensation, you go, oh man, I just had this awesome idea and I spent hours writing up this piece. And at the end of the day, it's a pass. And not a pass, but it's a small position that
Yeah,
definitely
yeah.
didn't warrant all that investigation.
Yeah, it happens. It happens. That's part. You got to pay the cost to be the boss, right?
That's it, my friend.
Yep. Well, all right, Benjamin, appreciate you for coming on. You all be sure to go subscribe to the ROI channel. I will link to that in the description, as well as subscribe to the newsletter. Well, you changed it. You changed your name a few times. You went with Maverick Life. Now you're the Royalty King, right?
Yeah. Well, I didn't. That came about because Steve nicknamed me that, and so I had to graciously accept it. The name of the publication is still the same. It's the ROI Club, and the Royalty King is kind of like the niche that I've just ended up in, I suppose, based on my philosophy and where I
That's
invest.
that name's pretty saucy, man. Royalty King, Yeah. I like it. I
Yeah,
like it.
I
Everybody
accept.
be sure to go subscribe to the Royalty King. You may need to claim that. You may need to claim that
Yeah.
on YouTube or whatnot. You may need to claim that. But all right then, we'll talk, Ben. Appreciate you.
Thank you, sir.